Gold has just traded above 4,700 Singapore dollars a troy ounce. That's a new all-time high, and yet, historically, it's still incredibly undervalued. Gold is heading towards, or could be heading towards, 15 to 20,000 Singapore dollars. Sovereign gold diversification has always had a very close historical relationship with base money, money in circulation, cash and reserves in the banks. Governments are constantly printing more money. This debases the currency, and gold has to play catch-up against the base money in circulation. The chart on the screen is a picture of the USA gold reserves as a valuation as a percentage of the base money, MO. The data was downloaded from the US Federal Reserve and the US government's databases. As you can see, from 1944, the line moves down. This was as the US government sold down its gold reserves and printed money. We moved into a base in 1971. Gold was then valued at $38. It was depegged and we moved into a considerable asset appreciation in the gold price. And it moved up to $850, which had a coverage ratio of base money to 132%. Then we moved down towards 2002, a consistent printing of money, a debasing of the currency. We saw a low in 2002. Gold at that particular juncture was valued at $275 US. Then we moved into the global financial crisis. Now, if we got back to the peak of 2008, in today's money, gold would have to be valued closer to $7,000 US. As you can see, where we find ourselves today at $3,300, $3,400 as of 2025, gold is still valued as a percentage of base money at the levels we saw in 1971. Gold is incredibly undervalued. If we moved up to the historical average of the last 250 years, gold would have to move closer to $10,000 US in today's money. As monetary aggregates expand, gold would have to continue to rise in price to keep pace with the monetary debasement. Gold as of today is not fully valued. It is still relatively inexpensive compared to the amount of currency in circulation. Governments will continue to debase money. Gold revaluation is irreversible. Follow us if you want to learn more.